Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking some time out of your busy day to spend it with us. It's interesting, this morning I was had the pleasure of being on BNN, Business News Network, and one of the anchors passed by me in the hall, and his comment to me was, we live in interesting times. And I think that sums up best what we're going through right now. A lot of questions, not as many answers, a lot of uncertainty. Perhaps the uncertainty is being caused on purpose, perhaps not, by the US President, President Trump. A lot of fear, a lot of individuals wondering how their portfolios are going to fare in a time of tariffs and certain restrictions. So it's a great time to have our show to answer as many questions that you have, you, the watcher today, has with respect to your portfolios, the markets, tariffs. We have a great guest on our show today that's going to shed some light on the automotive industry, an industry that is very important to Canada, very important to Southern Ontario. We have him coming off the top of the show. So let's put up what our show will be all about today. And there you have it. Tariffs in the auto industry, an interview with Barish Akirik. He's from Insights and Intelligence, Vice President, Auto Trader. He's going to talk to us about the automotive industry. A lot is going on surrounding the automotive industry. There was talk about tariffs coming on beginning of April. Well, 25% tariffs right across the board in Canada kind of brought that, I guess, 1 month sooner. The tariff update and the uncertainty update about tariffs. We'll talk about that, what's going on with respect to tariffs and the latest. Top 3 things to consider over the next 5 to 10 business days. Again, this is a very popular segment of our show. I'm going to be talking about 3 things that I think individual investors should focus on, or perhaps not focus on today before you make your investment decisions. Trump reducing regulations, taxes to attract new business. We're seeing more and more business coming into the U.S. The president is trying to make the environment for business and foreign investment more and more enticing. He's talked about just last night in his speech to Congress about cutting taxes and cutting regulation even further. That, along with tariffs on imports from businesses outside of the United States, makes it very enticing, or almost forces many businesses to open up something in the U.S. U.S. economy appears to be slowing, interesting enough. Prior to this talk about tariffs, we were starting to already see a slowdown in the U.S. Perhaps tariffs will exacerbate that, or maybe not. According to the president, he doesn't believe that tariffs will cause a further slowdown in the United States. He does acknowledge that there could be some painful moments in the short term for some gain in the long term. Stagflation worries appear. Stagflation, what is stagflation? We'll give a definition of it, and we'll talk about why the market is concerned about it. Quick hits, 3 things in the news that individual investors probably have seen. I'll comment on all of those. And lastly, we'll try and squeeze in at least one of your questions. So if you have any questions during the course of our show with respect to our guest, with respect to anything we discuss, questions, portfolios, economy, please put it in the chat box. And we'd be glad to try and answer the questions at the end of the show. If we run out of time, hopefully we can get to your questions before our next show. And if not, perhaps we'll answer them on our next show. So we have an action-packed, information-packed show for you today. And so let's move forward and get on with the show. I'd like to welcome Barish Akirik, Vice President of Insights and Intelligence at Auto Trader. Barish has more than a decade of Canadian auto industry experience, and he leads a research, analytics, and insights team that helps consumers, automakers, and dealerships make informed decisions. His expertise ranges from vehicle pricing to consumer behavior to industry trends. Welcome to the show, Barish. Great to have you.
Thanks for the invite. I appreciate it.
It's a great time to have you on our show to make sense out of all this. And hopefully you can help us make sense out of, I guess, shall we call it the chaos in Canada and the US right now. Interesting because I think the president would say not much chaos on their side, but definitely think the chaos is on their side as well as because we know that these tariffs are uh, causing some pain for U.S. consumers, just like us up here. So I thought we would start off with kind of some general questions about the auto industry. We know the auto industry makes up a large component Canadian GDP and importance to Canada and especially Southern Ontario. But what does the auto industry mean to you with respect to what it means to Canada and Ontario? Like, what would you say the importance is?
Importance is big. After energy, I think the automotive sector contribute is the second largest contributor to the economy, largest in Ontario. Lots of jobs. I think around 130,000 jobs directly are in automotive, and if you think about the broader impact, it's estimated to be around 600,000 jobs. So it's big, it's important. Um, yeah. So I mean, I think going back to what you were saying around, the there's being a chaos. That I agree with that, and that chaos I think continues today as well. There's some news that are being to be shared in the afternoon. So it's just we're going day by day. But on the other hand, obviously, it's very important for us to understand what's happening, not only for the business, but also for consumers, dealerships, and automotive manufacturers. So as soon as we know more, we dig into the data, we do research, we do analysis, and try to inform Canadians as much as possible.
Right. And so no wonder the Premier Ford has talked about potential loss of a few 100,000 jobs.
Yep.
It's definitely not an exaggerated number. What do you think the auto industry means to the United States? Let's say a state like Michigan, from looking at it from a higher level, obviously it would have a big impact. These tariffs would have a big impact on them as well, I would think.
Of course, of course. So, I mean, to be honest with you, for in terms of the impact on Michigan, I'm sure there's going to be a big impact, but we didn't do any analysis on that. We are concentrated on the Canadian market for obvious reasons. But on the other hand, so looking at high level, so we did some back of the envelope calculations to be able to estimate the potential impact of what Trump wants to achieve. So just to give you a few numbers and what we come up with our analysis is that in the US, 16 million new cars were sold in last year, right? And depending on the source, we export around 1 to 1.3 million cars down to the US, new cars that is, right? So it's about 9% of all cars sold in the US is manufactured in Canada, right? Give or take 8.8%, 9%. So, and what we did was, so you know how he wants to cut us off and produce all of these cars in the US. So what we did was we try to figure out, okay, on average, how many cars are being produced in an automotive plant? And it's around 212,000, give or take, right? And then it takes 18 to 30.
I think I think we lost our connection here. Oh, there he is.
Okay, I'm back.
He's
I'm back.
back.
I
He's
don't know
back.
what
There we
happened.
go.
I don't know what happened there, but
Live TV. There you go.
yes. Yeah, so what was I gonna say? What I was saying is that it takes 18 to 36 months to build a plant. And on average 212,000 cars on an annual basis. So even if they want to do this, cut us off and start building today, it would take them like more than 2 years to build these plants to be able to absorb all this Canadian manufactured vehicles. So to be honest with you, I don't think it's feasible. And in a couple of years, obviously there's the midterms, and then he's going to be out by, when is that, 2029? So there's not enough time to be able to convert this into an advantage based on how we've done it. So again, we don't think that this is feasible, but it is what it is.
Yeah.
We'll see what happens, Alan.
We'll see what happens. Yeah. Well, I know the Ford CEO, Jim Farley, suggested recently that the tariffs on Mexico and our country, Canada, I think his quote was, would blow a hole in the U.S. auto industry. And he's obviously been meeting with lawmakers to try and prevent this from happening. Um, do you actually think, like you mentioned, about how long it would take to build a plant or set up a plant? Do you actually think we could see plant closures up here that they could, in essence, I guess, be forced to reopen in the United States?
So again, I don't want to speculate because I don't think anyone knows, but we did do some thinking around this, and let me explain to you how we are thinking about this. So if this is a short-term thing, right? So probably again, based on what we've heard, I don't want to name any OEMs, but based on one OEM made a statement when these conversations started to come up. And then they said that it's a short-term thing. We'll just keep producing the same number of vehicles as we always do. I also had some confidential conversations with other individuals in Canada, and that seems to be the consensus, right? So if it's a short-term thing, we don't think that there's going to be an impact on production right away, right? And also, in addition to that, if you look at the new car inventory that's available on the lots, we are sitting around 80 days of supply, meaning that if there's no more new cars coming into the market, given the ongoing sales rate, it would take 80 days to deplete the existing inventory. So we have some buffer, right? And if it's a short-term thing, what we expect is that there's not going to be a big impact on production. But that said, if these, I mean, again, I know that we're in the middle of probably negotiations right now, but if these tariffs are short term and at 20 stay at 25%, of course there's going to be an impact on prices, right? Because everything's going to be more expensive. And what happens? Everything's more expensive. That means that the demand on new cars is going to come down, right? But if the supply keeps building up, right, there's going to be more supply, less demand. And in a normal economic environment, you know how we say economics 101, when the supply is up, demand is down, prices go down. But because of tariffs, we don't think that's going to happen. Prices will go up because of the tariffs. So that said, going back to what we observed during COVID, right? In COVID, beginning of COVID, I'm sure you remember, because of all these microchip shortages and supply chain disruptions and whatnot, there weren't enough new cars. So what happened to the demand? The demand shifted from new to used. So what we expect to see is that the same phenomena would happen, again, if the tariffs are short term. So what we expect to see is that demand is going to shift from new to used. And if you look at the used supply, there's some supply out there for sure, but it's also a bit constrained because of all these COVID era challenges. We've started to overlap those challenges. So supply is a little constrained. There's going to be more demand on the used side. And what we expect to see is that used car prices will react and they'll start to go up as well.
Yep.
So that's how we think about it short term. And if you ask me our long term view, I think that's a whole different animal.
Yeah.
If plants started to close, if this thing, more the next number of months or years, probably the impact wouldn't be only for the automotive market, but also for the entire economy.
What do you think about, you mentioned pricing briefly. I've heard that it could cause prices to go up anywhere from 3,000, 4,000 a vehicle to as much as 12,000 on some bigger trucks. Is that reasonable to think that prices could, I guess, and everything in between, I imagine, but prices could go up by that much?
Yeah, so I've read the same reports, Alan. But again, I'm not really a manufacturing expertise. I don't know. But the fact is that prices will go up, right? And think about it. So if price is $3,000, $12,000, whatever it is, and I think if you think about the consumer psychology, right, how we shop and how we buy things, right? If something that you want to buy is $70,000, right, and the next day it sells for 75 cents, whatever the case may be. It also creates a little bit of a hurdle, right? Mental, even though if you can financially afford that additional $5,000, right? Probably you wouldn't pull the trigger. At least I wouldn't. So I think whatever the numbers are, $3,000, $12,000, there will be an increase in prices, and therefore we'll see a change in consumer behavior and how they buy and what they buy.
Yeah, for sure, for sure. Would you say that all auto manufacturers will be affected in the same way, or do you think some manufacturers will be affected more than others? Will Ford be affected more than GM, or vice versa? Like, would it be exactly the same right across the board, or do you think there'd be disproportionate?
Probably, again, I don't want to speculate, and I don't want to get into a make model discussion, but probably there are going to be some differences depending on what percent is produced in Canada versus the US and Mexico. And there's a lot of like integration going on. And again, also in addition to that, the current availability is also is important. If there's a lot of cars for a certain make and model, probably they won't get impacted as much. But if there's a lot of demand on certain make and models, and if they are impacted, probably. But overall, there will be an impact. But at, how much would it affect Ford versus GM?
Hard to say. Yeah, I guess my last question, I would ask you more of a general question,
Sure.
not necessarily, well, I guess it is related. It's always related to tariffs these days. Interest rates. Do you find that more vehicles are sold in an environment where interest rates are coming down, lower interest rates? I would imagine that would be the case. And could interest rates dropping on both sides of the border offset perhaps some of the effects of these tariffs?
Yeah, good question. So we do have internal transactional data. So we have access to interest rates and transactional prices and loan terms. So let me tell you what we've been observing. So first of all, because of the decline in Bank of Canada's interest rates in the last while, we are seeing a corresponding decline in automotive loan rates as well. So just to give you maybe a couple of points here, high level, new car interest rates at some point hit on average 7.4%. It was November of 2023. And then they came down by quite a bit now, by 1.8%. Now we are sitting around, this is February data, and we're sitting around 5.6%. Same goes for used car interest rates. They didn't come down as much, but the average was around 11.3%, and now we're looking at 10.3%. So the short answer to your question is interest rates are declining, obviously good for affordability. But on the other hand, when we look at car prices based on the vehicles that we have on the site, and I'm not talking about transaction prices, I'm talking about listing prices. Prices are also coming down. So just to give you, again, a couple of data points, new car prices are down by 3.3% on a year-over-year basis, and now we're sitting at just below $65,000. And used car prices are down by 4.5% on a year-over-year basis, and now we're at 36.8. So prices are coming down, interest rates are coming down. So let's I know it's difficult to forget the tariff conversations, but let's put tariffs on the side for a second. So looking at the market has actually been doing pretty well, both for new and used in the last while. So going back to the COVID era, supply chain disruptions and microchip shortages and whatnot, we estimated that between 2020 and 2023, 1.5 million fewer cars were sold, new cars, right? So now that the cars are back in the market, so based on the inventory that we have here, there's some differences at the OEM level, but when you look at the aggregate level, we are almost at 2019 level. So inventory is back, cars are getting sold, and last year was pretty good, 8.2% year-over-year increase. Before that, it was around 14% increase for new vehicles. So cars are getting sold. Used car market, it was last year the story was twofold. The first part and it was a bit on the softer side. Again, going back to your question, prices were on the higher side, interest rates were higher, but they came down by quite a bit. And in fact, for used vehicle prices came down by 12.1% for 2024, largest recorded decline ever. So what happens, right? Prices are coming down, interest rates are coming down, people need cars, consumers need cars, and they're getting sold. So last quarter of last year was pretty strong. January was pretty strong. February, because of the weather and tariff conversations, we are seeing a little bit of softening. It's flat on a year-over-year basis. So if we just, forget about the elephant in the room, the market is actually healthy. But when you start talking about tariffs and 25% increase on stuff, $3,000 to $12,000 impact on new car prices, obviously that changes the whole equation. But again, hopefully we'll get some good news today, and we're going to go back to business and keep selling cars.
Yeah, for sure. Hopefully we get something this afternoon, as we've been told. Baris Akirik, Vice President of Insights and Intelligence at Auto Trader. Thank you so much for coming in, or I guess joining our show today, and giving us some insights into the auto industry. As you've said, a very big and important part of Canadian economy, GDP, and perhaps we'll look forward to bringing you back again down the road when tariffs are not the topic of conversation.
Hopefully not. Yes, but thanks for the invite. I appreciate it.
Thank you. Great interview from Baris, giving us a lot of information about economics, how everything is playing into the price of cars, and telling us that the car industry has been pretty strong, and telling us how used cars will be affected by the tariffs, and new cars, and the idea of bringing plants back to the U.S. is just it's silly, right? I know the president has said that, and in theory maybe, but it'll take a long time before they can actually do that. So hopefully we can, President, I think he'll be speaking to our Prime Minister Trudeau today, and hopefully something can be worked out. Tariff update and uncertainty. That's the topic of our next segment. And yeah, so it looks like 25% tariffs have been put on all goods coming from Canada and Mexico, and an additional 10% tariffs put on China. And what does it mean for the markets? Well, I thought before we talked about the markets, we actually have a chart shortly, but we could talk about a couple of deadlines coming up. March 12th, 25% tariffs possibly on steel and aluminum. April 2nd, fast forwarding to next month, 25% tariffs. Yeah, there you go, on EU, chips, phones, pharmaceuticals. That could be the next thing next month. And then this whole idea about reciprocal tariffs. And if someone tariffs the United States will tariff or put a tariff back on that country. And the president has spoken about certain countries in Europe, India, for example. I think his comment about India was they put a lot of tariffs on U.S. goods going into India. So there's a lot of tariff possibilities coming down the road just in the next month alone. Our first chart that we have here is one of the S&P 500. And this will show you, yeah, there it is. This shows you basically in the last month what this idea, the uncertainty of tariffs, are they going to happen? Yes, now that they've happened. Well, how long are they going to be in place for? We're hearing now that there could be some concessions, perhaps as early as this afternoon. Some things may change just in the next couple of hours. I think, as I said, the Prime Minister is set to talk to the President, and things could change. But you could see how volatile the markets have been really since the beginning of February. Next chart here shows the NASDAQ, which is even more sensitive. And you can see a clear decline in the NASDAQ as we got into mid-February. The NASDAQ was bumpy, but nowhere near, did we see anywhere near the declines that we've seen in the last couple of weeks. As we got closer to the March deadline for tariffs on Canada and Mexico, you started to see the market really begin to sell off. We have a TSX chart here, the S&P TSX index. Again, on the far right-hand side, the uncertainty of tariffs really taking hold. You see a bit of a bounce back on the far right of that chart, but overall a big sell-off. And we have some key tariff headlines that we wanted to show you on our next visual there. There it is. I'll just read out a few. These are some of the headlines we've been seeing from CNBC. Tariffs wipe out all profits for Detroit's big three if they don't raise prices, estimates Barclays. Another one, I guess, second one is kind of funny. Trump takes the dumbest tariff plunge, Wall Street Journal. How to lose the 21st century in 3 easy steps, Washington Post. Further down the road here, Canada and Mexico gambled on free trade future. The bet is turning sour. Once again, the Wall Street Journal. And here, The Economist. Trump's new tariffs are his most extreme ever. And last but not least, here, Reuters comment or headline. Tariffs would need to be in place for years to alter U.S.-Canada crude flows, Enbridge says. So a lot of headlines, a lot of uncertainty regarding tariffs, a lot of ups and downs in the market, a lot of clients asking questions, should we be doing something? And with this kind of volatility, it's really hard to answer that question. We just don't know what's going to happen. You sell an investment idea or an investment from your portfolio because of the tariff uncertainty, and then what happens? The president talks to the Prime Minister Trudeau, they come to some agreement, and then the market just zooms higher based on perhaps a cut in tariffs or perhaps some carve-outs for certain industries within the market. I saw automotive earlier today. GM was up, Ford was up, Magna, automotive parts supplier in our country, up a few dollars this morning on this news that perhaps the auto industry will be spared some of these tariffs. So the uncertainty is definitely there. And as Barish said in our interview, it's going to continue. It's going to continue for the foreseeable future until we have some certainty about the tariffs, whether they get removed altogether or, unfortunately, if they remain for the longer term. But uncertainty will continue. We just have to continue to look through the uncertainty and continue to stay focused, stay with good quality investments. And that, to me, is the best way to handle any of this uncertainty. Top 3 things to consider before you make your investment decisions. This is a staple for our show. We always like to bring 3 things that I want individual investors to focus on before you decide what investments to add to your portfolio. As you can see here, our top 3 list. First one, don't panic and make trades out of fear. I did receive a number of calls and even some emails asking whether certain individual investors should go to cash, should sell their portfolios out, what the cost would be, etc. I had to answer a few of those questions recently. Some people watching today might think, well, that's kind of silly, but it's not, right? People are fearful. We've seen a lot of gains in the last few years, and many individual investors don't want to see that lost. So, you don't want to panic at this point in time. Second point, many stocks are on sale. So kind of taking the approach from the other side, you don't want to panic, but you may want to look for bargains. There are a lot of things on sale in different sectors of the markets in the US and Canada. And so maybe it's a good time to look at those bargain prices on some stocks. And last, February jobs numbers. We don't hear a lot about the jobs numbers coming out on Friday. Today's Wednesday, only 2 days from now. Things were, I guess, I'll use the word normal, meaning there was no talk about tariffs. We'd probably all be focused on the jobs data because it's important. We want to see if inflation continues to tick higher in the US. We've seen it moving from closing in on 2% to 2.5%, CPI in the US now above 3%. We want to see how we're faring with respect to jobs in our country. We've seen good jobs numbers, but as I said, the jobs is a good indicator about inflation and how the path of inflation is going. So let's talk about the first point. Don't panic and make trades out of fear. One of the reasons why I always tell people not to panic, and you never know what the market brings, is for the first set of charts I'm going to show you. And S&P 500, our first chart here, if you take a chart of the S&P, now this is a pretty much a one-day chart, you could see how much the market sold off and then rebounded towards the end of yesterday. So anybody who sold off on the fear, you quickly saw the S&P rebound. It went flat for the day and ended the day slightly down. Today we woke up, S&P futures were higher. And even today, the S&P market has been, or the index has been flirting with positive and negative territory. So it's not a completely washout for the S&P 500. And so if you're selling because of fear, well, you might get burned. You might see a bit of a whiplash effect. Markets go down, some things are spoken about, new headlines are made, and the market reacts to the positive side. NASDAQ, which is our second chart, again, showing a daily chart. You can see on the far right-hand side, the NASDAQ actually went positive yesterday. I saw it at one point up 180 points on a day where the NASDAQ started off down 300 points. So again, doing something out of fear, doing something that, just because you're nervous and maybe you're hearing from friends or others that are bailing on this market, not a good idea. When you sell stocks based on fear, you want to make your investment decisions based on fundamentals, or if you're a technical analyst, you want to look at the charts and technical analysis side of things. But you never want to do things because it just gets a little bit fearful, or you're concerned about the way things are looking. Another example of the fear is Nvidia. We saw Nvidia yesterday, and this again, a daily chart on Nvidia. Look at the ups and downs in one day. Wow, unbelievable. If you look at what happened just before 4 o'clock, the Nvidia stock fell. Prior to 3 o'clock, we saw it on an upward swing. Really, I was on an upward swing all the way from 10 a.m. or just after 10 a.m. all the way to maybe 3:30 p.m. And then I guess people took a little bit of profit. But then after market, after 4 p.m., we saw Nvidia stock move higher again. And this morning, stock was down a little bit before we came on air. Not sure where it's trading at this moment. But once again, if you sold off on the initial decline in Nvidia, you probably would be angry at yourself because the stock rebounded significantly throughout most of the course of the day and then tailed off again. So doing things on fear, selling Nvidia, selling tech stocks, selling any investment idea is never a good idea. Some people put stop losses. So when the stock comes down, it sells when it reaches a certain price. That too can be risky because sometimes stocks fall and then go right back up. And so if you have a stop loss at a certain price and if the stock were to fall, it hits that price, it triggers, and then you watch as your stock goes right back up again. And I'm sure you wouldn't be too happy. So you want to, as I said, do things based on fundamentals, not necessarily based on anything else. Fundamentals, technicals, that's what you want to look at. Many stocks on sale. That's our second point that I wanted to harp on. And today, because there are many stocks on sale, our first chart has again the S&P 500 index. And I wanted to show how the index is performing because the index as a whole, I believe, is on sale. Yes, certain sectors of the market are on sale more than others. What goes up strong, unfortunately, can and usually goes down strong. So a lot of the bargains we're going to talk about on our show today are in the tech space. Tech moved higher for so long, so quickly, and we've seen multiples, valuations really get stretched. So when things started to get a little bit dicey with respect to tariffs, what do we see sell off? Well, we see some of the tech names, some of the biggest tech names out there today, they started to fall. The first tech name I have a chart of is Broadcom. Remember, Broadcom, chip maker. They make custom chips, among other things. And here you have Broadcom. Look how far Broadcom has fallen. Unbelievable. I actually have the stat here, down 24% when I looked at it this morning from its all-time high. Broadcom, a fantastic name, trading much cheaper than it was just a few weeks ago. Another name, not in the tech space, Bank of America. We saw Bank of America and many of the banks in the U.S. fall when tariffs were announced. Obviously, tariffs can and usually cause a slowdown in the economy because it's a tax on buying. It's a tax on goods. And so that ends up being reflected by the banks, right? The banks are the best indicator on how an economy is doing. And if economy starts to slow down because of, in this case, tariffs, well, that will affect the major banks. And Bank of America down about 12.5% since its recent 52-week high. So in the last few weeks, Bank of America has gone from about $48 to just over $42. And you can see that from the chart. AMD. Now, AMD is interesting. They are a US chip maker. They are the second biggest rival to NVIDIA. And AMD has been falling, not just recently, but for quite some time. Their results just seem to not be able to get the stock over the hump. And you can see how much this chart shows you the fall. At one point, they were a $227 stock. Today, before I came on air, stock was trading just under $100, a 56% decline from the highs. Yes, 56% for a fantastic company with fantastic management, fantastic CEO. Is that an opportunity to buy? Well, I guess it'll depend on you, the investor, and what your goals are and risk tolerance is. Our next chart here, Amazon, another stock that we've talked about many times. Amazon is on sale as well. Look at that chart falling off a pretty steep cliff on the end there on the right-hand side. Amazon down 15% from its recent high. And I believe our last chart, last but not least, is Google, Alphabet. Alphabet also is or has fallen significantly, down about 18% from its recent high. And the thing about Alphabet or Google is it is actually the cheapest Mag 7 name. It is the cheapest of the big tech stocks, trading at only 18, 19 times forward earnings. So there are definitely things on sale. We talked about a lot of the tech names that are on sale, one bank stock, other names that you might want to take a look at depending on your risk level and investment objectives. Other names, Caterpillar down quite a bit. They're the big machinery company. United Rentals, they rent large machinery as well. These names down significantly. Even if you look on the Canadian side, Celestica, a Canadian tech name tied to artificial intelligence, down from about over $200 a share down to about $130 a share. So overall, this to me gives us opportunity. So I know a lot of people are fearful about what's been going on, but when there's fear, we all know there's opportunity. And we always want to buy low and sell high. Perhaps now's the time to do it. Our third point that I want investors to look at or consider before you make your investment decisions is or are the jobs data at the end of the week. And we're going to get US jobs, Canadian jobs, and simply put, jobs are starting to, I guess, fall a little bit. Last month was down from December. January numbers were lower than December. We have a chart on US jobs growth. You'll see it here that the last month, 143,000 jobs gained, was actually lower than the prior 2 months. We don't really want to look at October because there were a lot of storms that affected things. But if you want to look at it going back to even September, that number was lower. So if you strip out October, it was the lowest number we've seen in the last 5 months, but stripping out October, the last 4 months. Canadian jobs, I think, are actually looking a little bit better than US jobs. And we have a chart on that. Canadian jobs, 76,000 jobs created in January. We'll see what they say for February. Pretty solid, 91,000 in December. Jobs is a very important number because jobs gives us an indication as to, amount of people employed, amount of people looking for work, JOLTS numbers, job openings. We want to know that as well. And that all comes into play when we start to figure out what the inflation situation or story looks like. And that's what the Bank of Canada and the Fed will be looking at. So along with not panicking, looking for bargains, you want to keep an eye on the macro. You want to keep an eye on jobs and what is reported on Friday morning when they report, usually around 8:30. So President Trump is obviously has already put tariffs on Canada, Mexico, and even more on China. And interesting thing, I look at the tariffs as kind of a distraction for what's really going on behind the scenes. And I think the president's using tariffs as a way to bring back business to the United States, which is, in my opinion, his number one goal. He wants to see manufacturing back into the U. Brought back into the U.S. He wants to see companies opening up facilities back to the U.S. And he's going to use tariffs as a bit of a scare tactic. If you don't bring business into the U.S. or if you don't want to be tariffed, then you have to, invest in the United States. But aside from that, he's also doing other things, such as talking about cutting taxes, deregulation, removing more and more red tape, making things even easier for businesses to come back to the US. And in my opinion, in order for us in Canada to compete with the US, compete for foreign investment, compete for foreign business, compete for those dollars, we're going to have to cut taxes. There's just no other way around it. And I think all of you watching today would probably agree. Our tax rates in the country are just way too high to be competitive corporately, individually. And we need to cut regulation as well. We need to make things a lot easier to do business between provinces, do business in general. And I think if we do that, that to me would be the best scenario to combat what's going on with our neighbors to the south. Our first chart here, potential U.S. policy changes. We have some, as you'll see in a moment. On the left-hand side, there they are. Key policies on tariffs, immigration, fiscal policy, which is, the Trump tax cuts. He wants to extend them and even increase them. Deregulation. On the right-hand side of this chart, talks about the fundamental impact of these policies. So fundamental impact of tariffs. Well, it's going to have economic impact. Prices are going to go up. It could slow down growth initially. Immigration. We've heard that the president is deporting many illegals or those that are doing illegal things in the United States back to where they came from. And will that have an impact on the jobs? Will that have an impact on the workforce and therefore be inflationary? Fiscal policy, tax cuts, how will that affect business earnings, people's earnings? Obviously, if we're paying less taxes, we are making more money. And last but not least, deregulation. Will that have an impact on interest rates and what the Fed does? All this, I think, will have an impact on what the Federal Reserve does. I think all this will have an impact on what the Bank of Canada does. And there's talk that Bank of Canada will perhaps lower interest rates quicker if tariffs remain on Canada for a longer period of time. If it's short-lived, then the Bank of Canada probably won't react. The longer-lived tariffs, I think, could have an impact on both the Federal Reserve and Bank of Canada. So to be competitive with the U.S., I think we have to look at, our federal government, whoever it's going to be in the months ahead. We will have an election. Whoever wins, I believe, needs to look at tax cuts, reducing taxes, income tax, and taxes on our businesses to remain competitive so that we can be competitive on a global scale. The U.S. economy does appear to be slowing, and we started to see numbers to show us this even before tariffs were, in the last couple of weeks when tariffs were spoken about. And on top of a slowing economy now in the U.S., if you get the tariffs, perhaps the slowdown happens even further and maybe forces the hand of the Federal Reserve, and perhaps that's what the president wants lower interest rates, and maybe tariffs on top of a slowing economy will get him just that. That's been one of the theories that has been, talked about out there today. Perhaps this is all to get the Fed to lower interest rates. I think it would be a pretty big, you have a lot of things at stake by doing it this way, but perhaps that's what the president wants. Our first chart here talks about the Atlanta Fed and their forecasts. And you can see their forecasts used to be a lot higher, but their forecast, GDP forecast for the first quarter, they're actually showing a negative 2.8%. That's the first time I've seen that, a negative number in a long time. Just the quarter before, we actually saw a number in the 2 to 3% range by the Atlanta Fed. Now, take that with a grain of salt. The Atlanta Fed is by no means, right all the time. There definitely will be some variation, but I think the direction is the more important thing. The fact that the Atlanta Fed is actually taking their direction into a negative direction, a negative number. And that just goes along with a slowing economy in the US. Our next few charts show, again, other areas of the US that are slowing. Retail sales, advanced monthly sales. You can see in January, another negative number, negative 0.9%. First time we've seen negative number for retail sales, again, in a long time. And if you look at what December was revised 0.7% positive. So retail sales are down, and that's disappointing. Next chart shows GDP in the US. GDP, again, coming down. And again, if you look at what the Atlanta Fed said, perhaps coming down a lot more for the first quarter of 2025. So you have GDP down, you have retail sales falling, housing in the US, although we did see some better numbers today because mortgage rates have come down because of what's going on with respect to tariffs. But up until recently, housing was softening as well. I have a chart here on it looks like on inflation. We can show that. It is showing where inflation sits, PCE, personal consumptions and expenditures, coming at around 2.5%. It's been about that for a little while now. So nothing that, in terms of a slowdown in the economy is weighing on inflation. You would think that inflation, would come down even further if the U.S. economy is slowing, but we're not really seeing that. What we are seeing is a lot of uncertainty and how that's playing out with respect to a slowing economy. We have a chart, another little illustration, probably my favorite for this show, showing small business and their activity. The uncertainty and is been rising, and with that, we're seeing that capex or spending plans coming down on small business. We're seeing consumer expectations, the consumer board coming down again with University of Michigan, which talks about consumer sentiment, how confident consumers are. Overall, investment sentiment in the bottom left corner is not good, is coming down, whereas economic policy and uncertainty have been rising. So I guess, the point is pretty clear. As uncertainty starts to creep up with respect to many things, such as tariffs, such as interest rates, inflation, we're seeing spending, business activity come down. And as I said, we're already seeing activity in the US slowing down. And unfortunately for the US and many, obviously everyone living in the US and even Canadians, as tariffs remain on Canada and all the business that Canada does with the US, the uncertainty will only stay high, and it will definitely affect growth in the US and obviously here in our country, Canada, for the foreseeable future. Stagflation. What is stagflation? Well, I can tell you the market's really focused on it. Simply put, stagflation is rising prices, but slowing growth. We actually have a definition we can put up for stagflation. It's an economic cycle characterized by slow growth, high unemployment rate, and high inflation. And from what we're seeing out of the US, if you think about it, what are we seeing? Well, slowing of growth, which we just spoke about. Unemployment rate perhaps will start to rise. We've seen a lot of layoffs just in government alone, and we're all waiting to see how those layoffs in the US will affect the unemployment rate and will affect jobs data. We could see a lot of people on the sidelines looking for work over the course of the next few months. We've already seen a lot of layoffs and high inflation. This is basically the risk that we believe tariffs when you put on goods coming into your country, you're going to increase prices, and that obviously brings inflation. Higher prices, higher inflation. We have our next chart here, U.S. Consumer Price Index, showing that inflation has started to tick up a little bit. CPI has ticked up back to 3%, PCE 2.5%, CPI 3%. So right now, if you kind of took the middle road between the two inflation indicators, you'd probably say U.S. inflation rate is between 2.5%, 3%. 2.75, 2.8, somewhere around there, and definitely a long way from the 2% target. So for me, overall, stagflation, is that a possibility? Probably not in the short term. You're probably going to have to see inflation rates a lot higher before we really start to dig in and talk about stagflation. Stagflation usually happens when inflation is 6, 7, 8%. But make no mistake, higher inflation with slowing growth is definitely catching the eye of the Federal Reserve, no doubt, and catching the eye of consumers, catching the eye of businesses, and definitely not good for them, and makes the job of the Federal Reserve a lot more when it's about to set interest rate policy, because you can't really cut rates to combat stagflation, and you don't want to raise interest rates either. So what do you do? And that's a dilemma that we'll have to see the Federal Reserve probably discuss and talk about in its, I guess, its upcoming meetings. Quick hits. This is the part of the show where I talk about a few things that caught my eye when I was looking at the news over the last few days, and perhaps it caught your eye as well. Lower interest rates drove Canadian GDP higher. That's probably an obvious one. When interest rates come down, growth starts to go higher, and we've seen that recently. Canadian banks are pushing to get rid of interprovincial trade barriers. There are trade barriers between the provinces. Yes, if you can believe it. Trading between provinces is something that happens, or we would like to see it happen a lot more. And there's talk that perhaps GDP in Canada could increase by removing those trade barriers. Last but not least, a funny one, bit of a funny one. Warren Buffett calls tariffs an act of war. And he says the tooth fairy doesn't pay them, or is not going to be paying these tariffs. It's going to come from the consumer or the businesses. So let's talk briefly about the first one. Lower interest rates drove Canadian GDP higher. And we have our first chart here, changes in Canadian GDP. And you can see how well GDP has done on a quarterly, well, you can see here, quarterly basis here. You can see GDP has been moving higher, Q4, Q3, Q2, etc. This is the change in GDP, definitely doing better than it was earlier in the year. You can see some charts actually showing a negative there. And I really believe this is because the Bank of Canada has aggressively cut rates, and to combat all the turmoil and slowing growth that tariffs can put on our economy here in Canada, US tariffs, I think you're going to see that the Bank of Canada cut rates a lot quicker going forward. So if you're all looking at perhaps getting a mortgage, a variable rate mortgage, I think you can look to seeing those mortgage rates fall in the coming quarters. The next topic that we have out of the quick hits, Canadian banks are pushing to remove interprovincial barriers. And there was some talk that you could see as much as, I think it was 3.2%. I saw that number somewhere, much as 3.2% gain in growth for the country if you just remove the barriers between the provinces. When you look at what the tariffs may cost Canada, I've seen numbers in that 3 to 4% range about regarding GDP. So perhaps if we get rid of interprovincial barriers, we can offset a lot of the negativity that tariffs are going to cause. Something that I know banks, obviously, and provinces have been discussing and have made note of. Our chart here, our one chart here, talks about internal trade barrier costs are greater for smaller provinces, which makes sense. So PEI, Nova Scotia, New Brunswick, these are the provinces that will benefit from getting rid of a lot of those trade barriers if possible. Obviously, it'll help a lot of other provinces, such as our province, Ontario, BC. But of course, our province is big enough to to withstand a lot of what's going to happen, more so than a smaller province, which if they had access to other markets in the country, they would fare a lot better. So hopefully we'll see these interprovincial trade barriers come down. Our last quick hit was that quote by Warren Buffett talking about, hey, it's not the tooth fairy that's going to pay these tariffs. It's going to come from either businesses or the consumer. So where the government is saying, countries around the world are going to pay these tariffs, swallow these tariffs, make a lot of money for the United States. It's possible, but I don't think it's going to come from Canada. I think it's going to come from the consumer, the end user, and or the business themselves. And this is actually his quote. Tariffs are actually We've had a lot of experience with them. They're an act of war to some degree. So he went on a limb and called it an act of war. Over time, they are a tax on goods. I mean, the tooth fairy doesn't pay them. And so even Warren Buffett is chiming in and arguably the best investor of our generation, and obviously saying or stopping maybe just one level short of saying that these tariffs shouldn't be applied, but he's obviously saying that they are and can be harmful to the economy. So those are your quick hits, and as I said, I wanted to end off with a bit of a humorous one from Warren Buffett. So I want to get to one of your questions at least. I always like to get to one. I know we had a guest, so the time is ticking here, a little bit longer of a show. But one of the questions I thought were really good. Markets were down in February. With all the uncertainty, I'm concerned it's going to drop even further. Is now the time to move to safer investments? So I thought this question was perfect for the show today. And my answer to that is, well, first of all, what is the word safer? Everybody has a different definition of the word safe. Some people will say GICs are safe. Some people will say bank stocks are safe. So as an investment advisor, the first question I would ask this person who asked this question was, what's your definition of safe? Should you move to more conservative, less volatile investments? Well, if you can, the answer is yes. But the reason why I say if you can, because it's going to depend on your investment objectives. If you want to look and need to have growth in your portfolio, it's very hard to sit in a portfolio of fixed income, bonds, GICs, short-term money markets, whatever it is, paying 3%. If you factor in inflation and taxes, you're really not making anything. In fact, you might actually be losing money buying those types of fixed income instruments. So I guess my answer is, should you be moving to safer investments is the question. It's going to depend on you, the investor, what you're looking for, what your goals are, and what kind of risk you can handle at these times. Because as I've said throughout the show, and I've said on many shows, BNN this morning on the network there, Bell Media, that the markets are going to be volatile. It's going to be a bumpy road for the foreseeable future. And those that are in the market, I still believe will have a positive return by the end of the year, but it's going to be choppy. And overall, I think we can squeeze out 8, 9, 10%, maybe even a 10 to 12% rate of return. But in the short term, it's going to be tough times for Canadians until we can resolve these tariff issues. So with that, I want to say thank you to everybody who tuned in today, watched the show. Hopefully you gained some insights, some knowledge from our guest, as well as hopefully I was able to answer some questions that some of you might have at this time. And as always, I want to tell all of you to tune in 2 weeks from today. We will have another guest. This is Trevor Toom, economics professor, University of Calgary, and director of fiscal and economic policy, School of Public Policy. He will join us to discuss things such as interprovincial trading and why these barriers should be brought down. And he'll talk to us about the economy in general. So always great when you can have an economics professor on the show. So I want to say again, thank you for watching. And until then, happy investing.